we'll take a step back and talk about portfolio strategy. What are the big themes which are emerging in the market? And if you are managing your own portfolio or you do follow the markets from a fundamental standpoint, we have a very special guest who's joining us today. He's in India right now. You may have read his book, Joys of Compounding. I'm talking about Gautam Baid, a regular contributor on the channel, and he tweets a lot as well. So you may have followed him. But today he's right here next to me in our studios to talk about Outlook 2023. Gautam, thank you so much for dropping by today.
Thank you, Ajay.
So Gautam, quickly, let's start with the main point right now worrying everybody globally. Higher for longer. Ever since this commentary has come from US Fed, all the portfolio managers are kind of on a back foot that, the environment may remain very full of turmoil for a long period of time. What are your thoughts on this matter?
I think more than the interest rates being higher for longer, the more concerning part for the market is the quantitative tightening by the Federal Reserve and by central banks globally, because as we all know, liquidity is like mother's milk for a bull market, and without very high liquidity, you cannot really have a global rally going on. So the entire markets globally will tend to become very narrow, and this is why I think active investing, after more than a decade of underperforming passive investing, is all set to make a very big comeback. And bottom-up stock picking is going to be more relevant than ever, because the broad indices may be range-bound because of high interest rates and tight liquidity, but bottom-up stock pickers will be handsomely rewarded. Another very important point to note here is that BAAP, or buy at any price investing, which was in vogue during the low interest rate environment, that strategy may underperform in a high interest rate environment, because most of these companies have got their cash flows very distant way into the future, and as interest rates go up, their intrinsic value is very sensitive to changes in the interest rate. So buy at any price or just ignoring valuations, that will not work. You have to be conscious of the value that you pay.
That's a very important point you made, that if stock pickers who are in the habit of looking for companies with superior quality of earnings, good quality management, all of that, it may well give you positive and good healthy returns, whereas the entire index may actually remain in a range. That's the kind of view which you're sharing. We'll try and get some graphics also on the channel of your views around that. But before that, also, you are spending a lot of time in US and also traveling across the world. How deep is this issue of slowdown in your view? Because it was an engineered slowdown by the US Fed to calm down inflation, but now some believe that it's actually overdoing on stalling of growth. How serious is the issue? In your own backyard in US, how are things on ground on growth front?
So if you look at the history of the Federal Reserve, they have a tendency to overshoot both on the downside as well as the upside. When they are easing, they ease too much, and when they tighten too much. So right now, the demand is still pretty strong in the US, and that is why the Federal Reserve wants to curtail what is known as the wealth effect. As long as people feel rich and as asset prices, asset inflation is in vogue, they'll try to keep increasing interest rates and tightening liquidity. And that is why the US, which is resilient so far, may enter into a recession next year. Europe is already facing a very sharp slowdown. So companies which export to the US will be the first ones to get affected, followed by companies which export to the US. So Europe first, US later. And the market is very efficient. Already we are seeing a sharp derating of many IT stocks in India over the last few months. Many of those stocks are around 40-50%. And the market has been very efficient in bifurcating the winners and the losers in this environment. So domestic facing companies, the domestic oriented companies will outperform going forward.
Right. Gautam, last 2 weeks, you've been also touring your friends, family, relatives everywhere in various parts of the country. How do you see the buzz here in India? I mean, G20 presidency, superior quality earnings, on-ground wedding season. You may have attended some weddings as well. How are things? What are you observing here?
I think the biggest observation has been that urban India and discretionary branded consumption is doing very, very well. But there is a clear slowdown in the rural parts of the country. But again, that is why you're getting cheap valuations in the rural facing stocks as well. In the stock markets, you pay a very high price for a cheery consensus. So if you feel that this is a short-term problem, then this is a good time to buy into those rural-facing stocks. Otherwise, you can stay with the tried and trusted branded consumption names, which have always done well in India over the long term.
But what about when you meet people from all income strata? Are they spending well? Are they optimistic about their future? I just want to understand the equivalent of consumer confidence data which comes out in US, but how is the consumer confidence here in India, which you are picking up in your interactions across the country?
I think the biggest observation again here is that there is a lot of pent up demand which is still in vogue. If you see No, let's take the example of Goa, for example. Over the next 2 months, if you see, more than 99% of all hotels are basically booked. That is the kind of demand traction that we are seeing in India right now. So, discretionary consumption is really booming right now. There's a lot of revenge spending also which is happening post-COVID. And see, whatever long-term durable items people had to buy, they've bought earlier, like all the home renovation items and buying the residential real estate. Now people are spending more on experiences. Now that is where the real spending is happening, experiences, and more of branded apparel, branded discretionary consumption, more of the lower ticket. Basically, if in India you can offer something which is aspirational yet affordable, basically you have hit the sweet spot. That is the area which is doing exceptionally well in India right now.
What about, you may have also met some managements or people who are working with corporations. What is the visibility on earnings growth for companies? When you met people in the supply chain of various companies you have in your portfolio, are you getting sense that worst of the margin issues are now behind them? How's growth, or growth is also kind of clouded in certain sectors? Talk to us about some feedback which your research, on-ground research you may have done around the corporate India.
I think most of the managements are now of the view that the worst of the raw material pressures are behind them. Okay. Actually, many raw materials are basically linked to the crude oil prices. And if you see the trajectory of the crude oil prices right now, most of the crude right now is trading below where it was at the start of the year. So bulk of the raw material pressure is basically behind us, and now you should experience margin expansion. But this margin expansion will not be enjoyed by all the companies. Only companies which have pricing power, which are able to hold on to their prices even amid falling raw material prices, those are the ones where you'll make disproportionate money. So you have to pick your spots very carefully.
Do you also feel this conundrum of valuation versus superior earnings? Because where there are superior earnings, valuations are not very cheap or fair, around the fair value zone. How do you kind of dabble between the two?
So one big learning from my investing journey over the last 15 years is that the great investors are active seekers of truth. And the truth in India is that the supply of high quality equities in the large cap and mid cap space is very limited. The stock price at any point of time is simply a function of supply and demand. So demand is high, but the supply of quality equities in India is very limited. And that is why comparing the valuations of stocks here with valuations of quality equities in US is futile, because in India the supply of quality equities is so limited. So that's why I think high quality large cap and mid cap stocks in India will always trade expensive. You may get them less expensive in a bear market, but I don't think you will ever get them cheap per se.
But also, how are you really looking at the matter of flows? Because the year gone by, the flows from the retail investors were almost like a renaissance moment, but FIs are big sellers. Do you see a case building that in 2023, while the domestic investors may not abandon the market, FIs on the margin may start coming back, and hence like a good situation? Or you think because of the global turmoil, FIs may not hurry to come in?
See, what I've observed from operating my India fund in the US is that a lot of these FIs, a lot of them act based on their short-term forecast of where the rupee is headed, where the flows are headed. So once the Federal Reserve is through with its interest rate tightening cycle, I think emerging markets are all set to make a comeback after that. And India may be the disproportionate beneficiary of that EM upcycle in the future. Domestic flows are anyways very resilient. In October, I believe we had 13,000 crores of inflows in the domestic mutual fund. So domestic investor has been very resilient, even among all the volatility. And when the emerging markets start receiving flows again from next year, once the interest rate hikes are done with, I think India may be the single biggest outperformer in the emerging markets pack from next year.
Interesting. Let's talk about how you are constructing your portfolio right now, or looking at opportunities or hunting for opportunity. Does anything in the primary market excite you, or have you looked at, or do you analyze it, but not making a move on any of them?
So there is an affordable housing finance company which I'm evaluating right now, which has got more than a 20-year track record of maintaining very good asset quality across cycles. It is a recently listed company in the primary market.
Okay.
So that is one opportunity which I'm looking at actively. But generally, majority of the primary market, or the IPOs as we call them, generally are very overpriced. So generally I tend to stay away. But sometimes when they undergo price correction, or when they, or when the initial investors or the anchor investors start booking out and the stock prices correct, those are the times to actually start looking at them. I think we should not really chase those exuberant listing pops, but we should just wait for the prices to come into our desired valuation range.
Before I talk to you about your themes which you are backing in your portfolio, Gautam, I want to talk to you about investor behavior, because you're also a student of behavioral finance to a large extent, and Buffett and Charlie Munger's prophecies on how investors do behave at any point in time and all of that. This, the entire craving for futures and options here in India. If you look at the data which some of the listed brokerages, tech brokerages are sharing, the amount of F&O related work volume is shooting through the roof, where the delivery base is stagnant or slow growth. When you meet around people, how do you see this phenomena?
I think I would rather go by hard facts than empirical data. If you look at what the Zerodha founder just said recently in a tweet, less than 1% of all traders in India have made less than the FD fixed deposit return. That basically says it all to me. Good investing is at the end of the day all about respecting base rates, or what is the probability of success in a particular strategy. And if less than 1% of all traders are making less than the fixed deposit return, this shows you how difficult it is to make money on a sustained basis. You may make a lot of money once or twice, but then the third time you may blow up. And then at the end of the day, the key to compounding is endurance and survival. And if you cannot survive, then you cannot really make it big in the stock market.
Lovely. Okay, let's talk about some of the areas you are, loading up in your portfolio. CRAMS, China +1, China plus Europe +1. Which sectors? Because this theme is also applied to 2-3 sectors differently. How are you looking at it, and how big is it, this theme?
I think the theme is here to stay for the next decade easily. I think low-cost contract manufacturing is in India's DNA. This is, and you should basically play games where you have the right to win. And I think India has got the right to win in this particular space. CRAMS, electronics manufacturing, outsourcing, domestic manufacturing is also very, promising theme driven by revival of the capex cycle and PLI. The domestic lenders, NBFCs, housing finance companies, banks, all are entering a fresh upcycle because most of the banking system has been cleaned up post IBC, and also domestic manufacturing. I'll again come back to that. If you see, capacity utilization across corporate India has inched up to a very high level now, and that is why many companies are embarking on a fresh round of capex. And history teaches us that one of the key drivers for a sustained bull market in any country is revival of the capex cycle, and that is where India stands today. So I think people are still underestimating the kind of returns which people can make from participating in this bull market, and that is how typically a bull market behaves. You have a lot of disbelievers in the beginning, but then it tends to surprise most of us on the upside.
What about lenders? How are you playing the lenders, banks, NBFC, this entire pocket, or some other insurance or AMCs? What kind of cherry picking are you doing there?
More than insurance and AMCs, I'm more bullish on the lenders per se, and banks and the private banks. I'm very bullish on companies which have got a very clean, which have cleaned up their balance sheet. A lot of people over the last few months have made a lot of money in the public sector banks. They are good for a trade. You can make your 1x, 2x in a short span of time, but you cannot really retain that wealth which you make from those PSU stocks, because at the end of the day, the majority owner is the government, which works for societal good, not for minority shareholder wealth creation. So be very careful to exit on time. Otherwise, you may again end up with permanent loss of capital in those companies.
You also look like the auto and auto ancillary space, which is coming back after almost a decade of underperformance. How are you playing that? Which side of the pocket?
So again, two-wheelers is a space which I'm looking at now, because there are some initial green shoots of recovery in the rural cycle. So I do have a branded, very strong company in the two-wheeler space which has got pricing power. And along with that, I think auto ancillaries, they generally tend to outperform the auto OEMs during an auto upcycle. So I also have exposure to some auto ancillary names in my India fund portfolio.
Excellent. So before I let you go, just want to understand all this mix of stocks that you have in your portfolio, Gautam. What is the kind of earnings growth trajectory, not on 12-month basis, but if we take a 2 to 3 year view, because that will be a good reflection of what kind of portfolio returns can be generated. You've made a part of in your portfolio.
Correct. So as we all know, over the long run, stock prices follow earnings, and for the current portfolio construct as a whole, over the next 3 to 5 years, I'm expecting a blended overall earnings growth expectation of 20%.
Okay, that's great. That's great. Wonderful, Gautam. Thanks very much for dropping by today. I really value our interaction, and our viewers, I'm sure, would benefit from your observations and, of course, your skill and your knowledge. Thank you very much for dropping by.
Thank you, Ajay.